Good morning, Mr. Bernard, and I'm Tseng. Today, me alongside with my group mates, Weng Jonathan, and Tow Yang, are going to evaluate the impacts of the COVID-19 pandemic on global financial services and financial mobility in developing countries.
The first developing country that will be covered in this topic is India. I will begin with the generic impact on Indian economy. The disruption of supply networks is one of the major effects of COVID-19 on the Indian economy. Numerous organizations are increasing their layoffs, which is hurting the industrial and services sectors. Workers have returned to their remote homes, making future expansion insecure. Another problem is the Indian rupee's continued decline. Therefore, the disruption of air travel, decline in the travel and transportation sector, and obstruction of entertainment services would result in NPAs and bankruptcy. Others cannot be exempted even if these effects are temporary. The infections are unclear, and the epidemic is still ongoing. And before sector links, these effects lead to additional ones. It has been noted that smaller firms' revenues would tend to decline during a global economic slowdown because of the existential crisis, which could have long-term effects on the financial system. Next, investment. Unmistakably, COVID-19 has disrupted many aspects of money investment. While new businesses are being developed, markets have been generally severely disrupted. This has led to the need for increased fund disclosure. Although earnings are elastic and liquidity is still an issue, there will need to be a long-term fix for all of these operational activity impediments as well as a way forward. Furthermore, the impact on tax and trade in India. Companies in the banking and financial markets are required to disclose taxes and comply with the tax laws explicitly. However, the challenges they will have when recording and paying direct and indirect taxes are similar to those that other firms face. It's possible that some experts are working remotely, collaborative gadgets might not be fully functional, procedures might be ambiguous, etc. For instance, these are probably appropriate requirements for acquiring tax compliance information, but not many businesses have made sustained, large-scale attempts at anything similar. It should be noted that although firms face extreme productivity and employee issues, human welfare continues to take precedence. Lastly, liquidity, maintenance, and increasing NPA. Businesses, enterprises, and corporates have all lost profits due to the COVID-19's continued growth and the limits imposed by the lockdown in India, which may cause a sharp rise in defaults. This growth will probably make it more difficult for financial institutions to maintain capital and liquidity. While the RBI's liquidity maintenance measures may be helpful in certain circumstances, banks must ensure that the additional funds are only used for short-term needs because CRR must be maintained generally. The banks must take care of this by setting up ongoing procedures to guarantee that these funds are only invested in respectable projects and do not lead to additional NPAs. That's all for me, and now I'll pass it to Wang Hong.
Thank you, Seng. Hi everyone, I'm Cheh Hong. Now I'll continue to discuss the impacts of COVID-19 on global financial service. For Philippines, Philippines' economy suffered a deep recession in 2020 due to the pandemic, with GDP contracting by 9.6% year over year. This was the largest annual decline ever recorded since the National Account Data Series for the Philippines commenced in 1946. Household final consumption expenditure fell by 7.9% year over year in calendar 2020, while gross capital formation contracted by 34.4% year over year. Although the economic activity had improved during the second half of the 2020, with positive quarter-on-quarter GDP growth recorded in the fourth quarter of 2020, the escalating pandemic in March and April 2021 has dampened the near-term recovery prospect. In real estate, a house became a refuge for all activities such as work, education, enjoyment, and other leisure activities. As the pandemic lasted, individuals understood the value of having a functional and secure home. Internet connection became the lifeline to carry out daily activities such as studying and working. Based on a study conducted by Santos Knight Frank, respondents from the Philippines have relocated due to the pandemic and are more inclined to buy a second property. Surprisingly, 85% of the local respondents had stated that they have changed residence since COVID-19 began, driven mainly by the demand for outside space, downsizing, and access to better amenities. This study also highlighted that 33% of the respondents changed their residence due to the demand for outside space, 17% for downsizing, and 70% for better amenities. For banking system, the COVID-19 pandemic has also become a catalyst in bridging the divide between the unbanked and the formal financial sector. It has served as an impetus for the widespread of digital payments, such as customers shifted toward the use of online platforms for their financial transactions. Meanwhile, the banking sector outlook survey of the Bangkok Central NG Filipinos BSP conducted in 2021 showed that Philippine banks have placed digitalization as a top priority for the next 2 years, mostly in the area of customers facing systems such as payments and deposits. For instance, transactions by e-wallet in the Philippines for 2020 surpassed 2017 by almost 149%, which was P2.30 trillion. Furthermore, for Mexico, the economic consequences of COVID-19 pandemic have been severe. In addition to death and illness, households have been burdened by shattered economies, resulting in a dramatic reduction in economic activities. The pandemic has been particularly harmful to economic activities in Mexico, where GDP initially declined by 8.5% and formal employment by 5%. Despite the severity of the recession, the Mexican government has offered no new public policies to aid the affected group. Unlike counterparts in high-income countries and similar Latin American countries. Moreover, compared to high-income countries, Mexico has fewer remote work opportunities and weaker public support systems. In loan, banks acted prudently during 2020 with limited loan origination, which resulted in a slight decrease in the system loans. Because the large bank built up the potential reserves in 2020, impairment charges declined in 2021, with some banks looking to resist reserve this year, benefiting the profitability. Notwithstanding regulatory approval to distribute dividends, Fitch expects the capital ratio to continue to improve due to the recently approved risk-weighted asset reduction in consumer lending and total loss-absorbing capacity adoption. Government programs to support individuals and SMEs since the pandemic have been limited, resulting in a lower loan growth compared to regional peers. Loan continued to contract at the end of June 2021 on a year-over-year basis with only a modest increase over the past 6 months. For digital payment, COVID-19 has highlighted the importance of digital payments and being connected to digital commerce, particularly for the resilience and the growth of micro and small business. Micro and small businesses experienced a significant decline in revenue during COVID-19, but some increased because of their acceptance of digital payment. 82% of the businesses reported a negative impact due to the COVID-19. The average business revenue fell by 33%, yet more than a third of businesses stated that they are accepting digital payment more than before COVID-19, and that they have increased home deliveries and online sales to help cope, highlighting the importance of digital payments in this pandemic context. Now, I'll pass it to Jonathan to continue the presentation.
Thank you, Weng. Hi, I'm Jonathan Chong, and now let's move on to the impacts of COVID-19 pandemic on the financial mobility of a developing country. The first country we are looking at is Brazil. The graph shown in the slide shows the net portfolio investment of Brazil between 2017 and 2021. As you can see, the net portfolio investment fell in 2020 and fell drastically in 2021. Moreover, it could be observed that 2021 is Brazil's lowest net portfolio investment in the last 5 years. The main factor for the steep drop in portfolio investment is the high default rate of many companies situated in Brazil. This is due to many disruptions caused by the COVID-19 pandemic, which halted many economic activities. As a result, businesses in Brazil lose profits, or in most cases, forced into bankruptcy. When more companies go into bankruptcy, investor confidence will dwindle. Therefore, investors are hesitant to invest in Brazilian companies. Similarly, domestic portfolio investments are unlikely to fare better. A report published in November 2020 shows that Brazil's unemployment rate is nearly 15%. However, since then, Brazil's unemployment has improved significantly, but it is still currently in the stages of recovery. Moving on to the next slide, we can see the graph for the net inflow of foreign direct investment in Brazil between 2017 to 2020. Once again, we can see a very similar pattern to the previous graph where the investment fell in 2020 during the pandemic. Likewise, the reasoning for the sharp decline in foreign direct investment could be attributed to the high default rate in Brazil. Many investors are unlikely to set up businesses and factories in Brazil when many companies are failing to stay afloat. Moreover, the economic downturn caused by the COVID-19 pandemic further complicates the issue, as foreign investors are less likely to be investing during this period of time. Moving forward to the next country, we have Pakistan. The graph on this slide showcases Pakistan's net portfolio investment between 2017 and 2021. As seen on the graph, the net portfolio investment of Pakistan increased in 2020, unlike most countries during the pandemic, but then fell significantly in the following year of 2021. One of the key explanations given to explain the high portfolio investment is that Pakistan is extremely friendly towards foreign investors. Particularly, foreign investors are subjected to the similar tax rates to domestic investors. Furthermore, foreign investors are open to investing in any and all sectors and activities unless specifically prohibited for national security reasons. Another factor to consider is that the inflation rate of Pakistan decreased each month in 2020, thus attracting more foreign investors to Pakistan. However, as the COVID-19 pandemic worsened in Pakistan in 2022, it urged many foreign investors to withdraw their foreign portfolio investment, hence explaining the sharp decline seen in 2021 in Pakistan's net portfolio investment. Moving onwards to the next slide, this graph shows the net inflow of foreign direct investment to Pakistan. Although Pakistan's net inflow of foreign direct investment fell in 2020, the fall is not as severe as Brazil's net inflow of foreign direct investment in 2020. This could likely be explained in a similar fashion to the previous paragraph, as there are many incentives for foreign investors to invest in Pakistan. As a result, cushioning the fall of foreign direct investment much better than in other developing nations. Now, I'll let Tow Yang to complete the rest of the presentation.
Thank you, Jonathan. Hi, my name is Lim Tow Yang, and now I'm going to present about the impacts of the COVID-19 pandemic on foreign direct investment in Nigeria. By using the monthly data from 2016 to 2020, which shows Nigeria's changing trends of foreign investment inflows, a peak was seen in late 2017 because of the limited economic stability, but the economy had a high shock in 2018 as a result of the global shock on oil prices. Because Nigeria is a monocultural economy that obtains 80% of its revenue from the sales of crude oil, a price shock in the global market has a broad impact on the country's macroeconomic operations. Another shock occurred in 2020, which may be attributed to the country's COVID pandemic situation, considering Nigeria's shifting trend pattern in the FDI. Furthermore, the COVID-19 has restricted Nigeria's access to the foreign market, which is in every country's national interest and is accomplished through exportations, joint ventures, and direct investment. Direct investments are impacted since the worldwide lockdown to prevent the spread of the extremely viral disease. The decrease in oil prices does not allow Nigeria in a position to communicate any major joint ventures or direct investments in the economy of the other countries, which would have increased its access to the international market. Nigeria's oil sector accounts more than 80% of exports, 30% of banking sector credit, and almost 50% of the overall government revenues. Other than that, the non-oil industrial and service sectors rely on the oil industry's economic activity and the fiscal revenue. As a result, the performance of the oil industry has a significant impact on the economic activity, investment, and credit expansion, all of which have been impacted by the COVID-19 pandemic. In addition, the COVID-19 pandemic has also prevented Nigeria from gaining the advantages of FDI. All of this has been found to have avoided Nigeria. The pandemic has resulted in a 5-point drop in growth. Because of the COVID-19 pandemic, the country has lost significantly FDI gains, as there has been a huge decline in the FDI inflows. So the conclusion for national development is that the country's slow FDI inflow may not be sufficient to act as a driving force behind Nigeria's economic competitiveness. Moreover, Nigeria's balance of payments fell further in 2020, from negative 17 billion in 2019 to 16.2 billion in 2020. while net FDI inflows into the country, which would have helped to ease some or all of the government's negative balance of payment current account, or it can cover the expanding gap over time, which had dropped to 2.6 billion in the same year. As a result, Nigeria is in a risky position to escape the account balance of payment issue. Last but not least, more foreign investors are expected to explore investing in business and projects that are nearby to their home countries, which results in a pause in activity, reshoring or nearshoring of operations to reduce the reliance on the global supply chains. Hence, in the short to medium term, globalization may be a regionalized development. The temporary pause in FDI due to the COVID-19 pandemic will affect the economies differently, and the rate at which each government responds to the pandemic, as well as the time it takes for each economy to recover, will primarily decide the flow of the FDI back into the country. It appears that the developing economies like Nigeria would have the slowest recovery of FDI flows, since there is a danger that the types of FDI projects most likely to be postponed or abandoned are those amid the emerging economies. The decrease in global FDI flow is likely to have a more negative impacts on developing economies, which rely heavily on FDI inflows due to the economic benefits of those inflows. As a result, Nigeria have been competing fiercely to attract FDI from developed economies, especially in their primary and manufacturing sectors. And that is all from our group. Thank you so much for lending us your ears.
My question to you is, what is the effect of long-term currency devaluation?
Long-term currency devaluation can have serious negative effects. First, local items are consumed more frequently as a result of rising import prices, while overall consumer purchasing power is declining. Inflationary pressures are also brought on by costly imports and higher export demand from abroad. Domestic consumption could go down overall. Finally, local industries are supported by the higher prices of imported products. Some industries are projected to become less productive and efficient in the medium future as there is less external competition. After a devaluation, consumers who have liabilities in foreign currencies will notice a significant increase in the cost of repaying such debts.
Hi, here's my question for you. So, how does COVID-19 accelerate the process of digitalization? Thank you.
When the pandemic first hit, most of the operations stopped and the movement of people were limited. People tended to rely more on digital payment rather than cash. For example, if people wanted to order food online or shop online, the easier and more convenient way to make payment is through digital payment. People still have to go out to purchase daily supplies, though they could still choose to pay with cash. They were also encouraged to pay with digital wallet method, such as e-wallet, to reduce contact. Hence, the usage of digital wallet has increased ever since the pandemic first started, which also indicate that COVID-19 did speed up the process of digitalization.
Hi, so my question to your group is, will the COVID-19 lockdown and restrictions further worsen Brazil's FDI and portfolio investment? If so, why?
Thank you for the question. Brazil's foreign direct investment and portfolio investment will certainly suffer if there are more lockdowns and restrictions placed in Brazil. Additionally, it is doubtful whether the Brazilian economy can handle another lockdown or restrictions. After all, Brazil is still in its recovery stage and has yet to recover to its pre-pandemic level of foreign direct investment and portfolio investment. However, in the event of lockdowns and restrictions were to happen, the Brazilian government have created policies to somewhat mitigate the damages that could occur. Most of the policies involve monetary policies via financial aid such as debt renegotiation, financing for payrolls, and emergency credit lines. Although, it should be noted that as of April 2022, the Brazilian government has lifted most of its COVID-19 restrictions.
The next question for you guys is, what are the impacts of exchange rates on FDI?
So the exchange rates could have an impact on both the overall amount of the foreign direct investment and the distribution of this investment expenditure across a number of countries. So like when a currency depreciates, its values fall compared to the value of another currency. So these exchange rate fluctuations can have two effects on the FDI. First, it lowers the country's wages and the production costs in comparison to its international competitors. All else being equal, the country suffering real currency depreciation has also improved its attraction as a location for productive capacity investment. And the exchange rate depreciation also able to boost the overall rate of return for the foreigners considering an international investment project in this country via the so-called relative wage channel.